Hi, hoping you are having a great time. This is Professor Ramakrishna and welcome to my YouTube channel Archiversity. Along with this YouTube channel Archiversity, I also have a website that is www.archiversity.com, where from you can download the playlists of hundreds of video lectures on different topics of finance, accounting and management, and watch anytime, anywhere at your leisure. In this lecture, I'm going to explain you the principles of accounting. And mastering these principles of accounting is going to decide your future related to accounting career. Once you get familiar, you get accustomed, and you have a thorough understanding of accounting principles, throughout your accounting career, your life will be smooth sailing. If you fail to understand the accounting principles at the initial level itself, then at every step in your career of accounting, you get confused and you will commit more and more errors, and which will jeopardize your career. So in this context, I suggest you to pay a keen attention in understanding the accounting principles which are explained in this lecture. Without any delay, we start our discussion on accounting principles. The accounting principles are your basic rules or guidelines which help you to prepare financial statements and report your financials. So in this context, in the sense, every time when you have to prepare your financial statement, starting from recording your transaction in a journal entry to preparation of a financial statements and a closing of your books, at everywhere you have to follow certain principles which are going to be a key determinants for completing or fulfilling your core objectives of accounting. So here we have a few important accounting principles. We can say that is GAAP principles, or similarly you can have a generally accepted accounting principles. So among these principles, I'll start with the business entity. That is the first accounting principle which we have to pay keen attention on. So when you're talking about a business entity, this is also called as separate entity concept or separate entity. Now, why is business entity or a separate entity is when a business is registered, in the sense registered in the form of a company or a private limited company or partnership, which is registered, then the company will be separate from its owners. So owners are separated from the company. Let us say you and your friends float a company saying that Accounting Limited, and in which five friends makes an investment of rupees 10 lakhs. So this rupees 10 lakhs what you spent is your investment into the company. That means once a company is registered, then you will be separate from this. In the sense, for a company, this is an investment. So you made an investment in the company. For the company, it is an amount which has to repay to you. So as this business entity is there, now once you float a company and registered it, then any transactions that happens, any assets that are purchased, they are purchased in the name of the company only. Suppose if you purchase a furniture for your company, then so furniture will be Accounting Limited, on the name of Accounting Limited only. If you take a lease of a property, lease is on the name of Accounting Limited. And if you hire employees, then they are hired for employees. Even if you are working in a company also, then you will also become an employee of this company. And as you are working for this company, you will be paid for your services. So the clear thing is that the owners and company are different. That means any transactions related to your personal will not be related or linked with the company. Suppose you from a company, let us say you borrowed money or you withdrawn rupees 50,000. So this 50,000 is the amount that you have to repay to the company. In other terms, you can say that this is simply you borrowed money. As you borrow from a bank or a financial institution, you borrowed money from the company and you have to repay. That means you have to clearly understand that once a company is floated, you are considered separately from the company. Next comes is our monetary unit. So when we are talking about a monetary unit, the business uses different economic resources to produce goods and services. So different economic services, like it will buy a furniture, it will pay rents, and it will purchase land, and let us say it purchases it employs workers likewise, and each of these are measured in different units of measurement. Take for example, if you have a furniture, you will count them as a number of tables and benches, or like that, number of tables, number of computers and all. When you are paying a rent, you pay a rent per month in terms of rupees. If you have land is acquired in percentage of a square yards or square feet. Then you, for employees, their number of working days and their salary. So as these have a different units of a measurement. So in accounting, what is that you have to do this? The principle is that all these different units of a measurement need to be, as we have a different units of measurement, these need to be converted in terms of a monetary and record in your accounts. So there is a monetary concept. Next, we look at the going concern concept. When a company is floated, going concern, that means that we expect that the company is having a perpetual existence. Now you can see that many companies proudly say that they are established in 1890. So some companies says that they are established in the year 1925. Likewise, that means each company is established in these years and still they are in operations. So when we are making an investment into a company or when we are floating a company, the promoters or the owners expect that the company will have a longer lifetime or its existence is a perpetual. So keeping this perpetuity in mind, we will prepare our financial statements. On this basis only we will prepare whether our accounts should be permanent accounts or temporary accounts. Now once we have a perpetuity, then we think about the time period. As we are saying that the perpetuity, let us say a company is floated in the year 2000 and it has a perpetuity and there is no end for this. If this is a scenario, then how is that we are going to know whether we are progressing in our company or not, whether we are earning any profit or not, what are the assets that we have or how much amount that we own? Nothing is known because nothing is mentioned here, because we are making this as a perpetual one. So to overcome this disadvantage, what is that we do is we make this into a periods. So time period, let us say we make this into a time period concept. According to our time period concept, what is that we do is we break the total life into a time periods of a 12 months. So 12 months or we can say that one financial year. Just one financial year. So this total period is split into 12 months every time. So 12 likewise each financial year is mentioned. Now what is that we do is for each financial year we balance our accounts, in the sense we will try to know that what is our position at the end of the year and how much money that we made. So here let us say we have a financial year, one financial year. For this financial year we prepare our statements and we try to know how much net income we earned during this particular period, and what is our asset position, or what is our position of this company, our company on this date. So for this purpose, we use a concept called as a accounting period or a time period concept. That means each time period, that is a financial year or accounting year or accounting period concept, tells us that all your transactions or activities which you are performing from your business need to be break down into a financial year or accounting year to know how much you earned, or what is your net income, what is your financial position, how much amount you owe to the others. So this is the concept of a time period, because of which we prepare our financial statements on the basis of yearly basis. Then comes is your historical cost. So when you're talking about historical cost, so all the assets that we procure for our business or we buy for our business need to be recorded on the basis of its historical cost. In the sense, suppose if purchased a machinery worth rupees 1 crore and you spent on this machinery, let us say, another rupees 10 lakhs for installation. So this becomes 1.1 crore. So in your books of records, you have to record this amount. And once this is done, in future, if the value of this asset increases also, we are not going to consider. Similarly, let us say you purchase the land and 1 acre of a land for rupees 10 crore. Now in your books of records, we'll enter this as a rupees 10 crore land. As we are a money measurement concept, we are not recording the 1 crore, that is a unit of measurement of a land, but we are recording in terms of a money measurement, that is a 10 crores is recorded as a historical cost. And every year we show this as our cost. If we are using this asset for our usage, then we will depreciate its value. So even after depreciation, whatever the value is there, then we'll record. Let us say we depreciate this particular asset at a 10%. So that means 10% of 10 crore is 1 crore. So we show 9 crore as a balance in the next accounting year. But this will be recorded only at a historical cost. But assume that after 10 years, this land what we purchased at 10 crore may worth rupees 100 crore. So the market value of this asset may be 100 crore after 10 years. But after 10th year also, in our balance sheet, we record this as our historical cost only, not with the market price. So any assets that we have, we record, or anything that is there, we record only based on their historical cost, not on the market cost. Then comes our matching principle. So in case of a matching principle, as we are saying that we have an accounting period or a time period, let us say we have a one accounting period, a financial year 2022-23 is the financial year we have. So according to matching period, what is that we do is, here we record all the revenues that we have generated and we match these revenues with the expenses. Any expenses spent to generate these revenues during this particular year is matched. So this we call as a matching principle. Suppose you made a sale and you produced goods worth of rupees 10 crores and made sale. So all this 10 crores has been sold. So to make this 10 crores, you spent 4 crores as an expenditure. So all this expenditure is matched. However, sometimes we pay an amount which is beyond utilized beyond this particular year. So let us say you purchased an insurance policy for 2 years. So then what is that we do is, because this expenditure is incurred for the 2 years, but we match only 1 year amount. That means in our expenditure, let us say for 2 years, you bought this insurance policy for 2 lakhs and this is for 2 years. So what is that we do is, we match this 1 lakh in 1 year and another lakh in another year. So that means even though we spent an expenditure which is 2 lakhs, But in records, what is that we do is we show this 1 lakh in 1 year and another lakh in another year, because we have to match our revenues with our expenditure pertaining to that particular accounting year or a financial year. So this is going to be a very, very important one in the basis of an important topic in basis of accounting. So understanding this is very crucial to understand the basis of accounting. So for now, you have to see that matching concepts tells that all the expenses incurred for a particular accounting year need to be reported or matched with the revenues of that particular accounting year. Then comes your revenue recognition. So here, when we are talking about a revenue recognition, we have to see that the revenue earned during that period need to be considered into accounts. That means whenever a sale is made, a revenue is recognized. That means irrespective of whether you receive a cash or not, so your revenue is recognized. That means, let us say you made a sale of a 10 crore. On this, 5 crore is on a cash basis and another 5 crore is on basis of on credit, another 5 crore. So even though this is a cash which you receive immediately and this credit which leads to your receivables, this also need to be recorded. That means revenue recognition, whenever you earned a revenue during that year only, you have to recognize. Again, your revenue recognition it also matches with your time period concept. So if you observe by this time, each and every accounting period is, or accounting principle is interlinked or related with the other accounting principles. Then comes your materiality principle. So while making a materiality principle, two assumptions are made. One is that you have to see whether the expenditure or income is really material, in the sense whether this can be considered. Say suppose sometimes you spend 10 lakhs 45,932 rupees 50 pice. So now what is that we do is we try to round off this, that is rupees 10 lakhs 45,930 or 940, right? So then this 2 rupees 50 pice, we may consider this as an immaterial. Or sometimes we spend a smaller amount like a rupees 50 paid. So instead of these individually entering these transactions, we can see that this is not much material or not going to impact, where in our company we are making a turnover of thousands of crores. So in that scenario, what is that we can do is all these expenses or petty expenses are clubbed together into one and accumulated for a month or some time period, and that amount may be considered. This is one. Second is, when you're talking about a materiality, every income that we receive or every expenditure that we spend need to be supported with the material evidence. That means, say suppose you have to create invoices. So invoices for your all your sales invoices, all your purchase invoices, if you are making a payment invoices. So every amount that is spent from your business entity or from your organization should have a material evidences for them, so that based on these material evidences in future we'll see that whether our accounting is properly done or not. Then the other important aspect is the full disclosure. So the concept of a full disclosure says that so the accounting should provide complete information to the stakeholders. All whatever the possible extent to the publicly available information need to be provided by the accounting. It need to be provided. That means, so you have to here you have to make what are your accounting policies and how actually you prepare this, and what are your accounting treatments, like what kind of accounting treatments you have made for each account, how you made your provisions, why if there is any loss, what are the reasons for a loss, and any changes in a policy, any changes legal issues. Every information need to be provided in your annual reports or financial statements. In the sense, all the possible accounting information need to be fully disclosed to the stakeholders, so that this financial accounting will help them or permit them to take wise investment judgments. And the final one is the concept of a conservatism. So conservatism also sometimes also called as a concept of a prudence. This concept tells that in a business, when you are making your recording, or when you are recording your transactions, you have to provide full provision for losses or payments. And when you are supposed to receive the money, or when you have to get the money, then you have to create a provision, or you can estimate a lesser amount. In the sense, in simple terms, the concept prudence of conservatism says that, so suppose if you have to pay rupees 5 lakhs to your creditors. So in such scenario, in your accounting, you have to show the provision of whole 5 lakhs as the amount to be paid. That means when you are anticipating a losses, anticipate the higher, when you are supposed to be paid, you say that you have to pay the 5 lakhs. Let us say, on the other hand, let us say you have to receive 5 lakhs from your debtors, that is the receivables. In such a case, there is every possibility that there are some of your debtors may not be able to pay you. Let us say 5% of this may not be pay you. So then you have to create a provision for 5% on this, that is around 25,000. You make a provision and says, and in your account shows that the amount that is to be received is 4,75,000. So in simple terms, the conservatism concept tells that when you have to make a payment, you have to pay the complete amount. When you are supposed to receive amount, create a provision. So it says that anticipate all future losses, and when it comes to the income, underestimate or understate your income or net assets. So this is the reason why many of our we create a provision for our bad and doubtful debts. We created bad debts, then we depreciate our accounts at a higher rate. So these all are the examples of your conservatism. So these are the core accounting principles based on which we prepare our financial statements. So in my coming lectures, I am going to, whenever any accounting transaction is to be recorded in a journal, ledger, or preparation of your balance sheets anywhere, so at each and every stage I am going to link these accounting principles with our transactions and events which we are going to record in the books of records, so that you will be able to understand, you will be able to appreciate the relevance or linkage between accounting principles and accounting records. Thank you very much for listening to the lecture. Hope I didn't bore you with this lengthy lecture, but this is very much required, because once you get master, or once you are thorough with accounting principles, as I said in the beginning, your accounting career will be a cakewalk, and you can reach the highest levels in an accounting career. But if you fail to understand the accounting principles and appreciate their relevance or usage, then you are spoiling your accounting career. Thank you. Hope to see you other day with other video.